with the commodity price changes that we've seen due to COVID, that's something to certainly think about. So, but we had some interesting times as COVID hit back in March. Those of you that know Halderman know that we do a lot of live public auctions. So that's one of our staples and has been for my entire career, 32 years. And all of a sudden, come April, we could not do those by Governor of Ohio, Governor of Indiana. We had sales in both those states, and so we had to kind of rapidly change what we were doing. And we did so. So I'll talk a little bit about that. But to start out with the Halderman companies, and I need to make sure this is right for everybody. There we go. So the Halderman companies have been around 90 years this year. We were founded in 1930 by the guy there in the middle, my grandfather, Howard Halderman. He based the company out of Wabash, Indiana, so just up the road, 20 miles or so from Marion, and we've been based here ever since. We do have offices in a variety of locations at this point. Our role is representing landowners, and so we represent all sorts of landowners, people that most of our clients would be individuals, but we do have landowners that would be bank trust departments, that would be corporations, that would be different entities, like the Nature Conservancy is one of our clients, that own farm real estate, and basically they don't farm it themselves. And they say, Halderman, can you help me manage my property? Can you help me sell my property? And we specialize in farmland. And so as a result, that's where the basis of our business is today. And like I said, 90 years doing it. So the scope of our business, we're managing almost 700 farms, 240,000 acres, and we do cover 19 states. Now, most of our business is going to be Indiana, Ohio, Michigan, and Illinois, but we do have assets that we manage in 19 states across the union. And then you can see our real estate sales volume, 110 farms, 13,000 acres a year. And we're also doing 800 appraisals. Most of those appraisals are going to be done for bank collateral, loans, basically. But we do a fair number of appraisals also for estates. So one generation passes on, leaving it to the next, and we'll do an appraisal for that. So you kind of think of it as a three-legged stool. We have the farm management, we have the real estate sales, and we have the farm appraisals, and they all link together. And if you own a farm and have us manage it, you might want to know what the return on investment is. We'll talk about cap rate here in a few minutes. And so that return on investment, you need to know the value of the farm to calculate that. So that's an appraisal. And many times a landowner may say to us, well, Howard, you're managing this farm for me and I would like to invest in more farmland. Can you help me? And that is something we do. So you can kind of see how those services all interlink and give our staff a very good basis of knowledge as to what we do and what's happening in the farm real estate market each day and each year. So as I said earlier, we're founded in 1930. I am the third generation owner of the company. We've got 22 area representatives in Indiana, Ohio, and Michigan. And then the most important thing is the last statement on this slide, which is the average tenure of our staff is greater than 20 years. And that tells you that our staff knows the area they're in. They know the farmers, they know the land, they know the marketplace, and you get a lot of knowledge and experience when you engage with a Halderman area representative. And then this slide just shows you the states that we do manage properties in. So we go from potatoes in Idaho to corn and soybeans in North Carolina, all the way down to vegetable crops in Florida or blueberries in Georgia. But most of our business is going to be right here in Indiana, Ohio, and Michigan. And that's where a lot of my comments will come from today. So I mentioned earlier that we had to drastically change, no different than a lot of businesses did, how we do business back in late March. And so our area representatives all work from their homes. So for them, it really wasn't a huge change. You know, this work at home, shut at home order was not a huge change for them. They were working from their homes mostly, or they were working from an office where there was one or two people, and being in the agriculture business, we were deemed essential. So a lot of our operations continued unimpeded, except for auctions. And as some of you may know, if you've attended one of our auctions, they tend to be a pretty fun experience. You have a big crowd, and it's really about human engagement, which all of a sudden with COVID was no longer allowed. So what do? We switched, and we've been doing online auctions as Halderman Real Estate for about 5 to 6 years. So technology, system, and process, we had all of that in place. And so we very rapidly transitioned all of our April auctions, and there were 10. We moved them all to online only, and talked to all of our sellers. They agreed to proceed. Advertising was already out at that point, so we kind of had to change our advertising approach to tell people, don't go to the site. Nobody will be there, although we would send somebody to the site just in case somebody didn't see that change. But please bid online or call us, and we can take phone bids. So here's what we learned. We had 10 auctions. The positives that we saw were that, obviously, from our perspective and from the bidders and for the sellers, limited travel. You were able to bid at home, or we were able to take your bids and work out of the Wabash office, which is about a half mile from my house. And so our staff had less time involved as well. It was less emotional. That can be good and bad. Sometimes when you're in a room with neighbors and friends, it can be a little more emotional. But sometimes we as a selling agent like to play on that emotion. So it was a little less emotional. It allowed people to bid from anywhere in the world. We had a serviceman bid earlier this year from Japan. So just evidencing that you can bid from anywhere in the world, and that's a positive. That gives people the ability to be wherever they needed to be and bid on a property they may want to own. It saves time. At the end of the day, the process, while we opened the online bidding window from 8 a.m. the day before the conclusion of the auction to basically 6:30 p.m. or 6:45 p.m. on the day the sale was originally advertised. So you had a couple of days to bid on it. But in reality, you could bid, go away, do other things, and then ultimately come back and check your bid later. And really, you only needed to pay attention for the last 15, 20 minutes. You might ask, well, what happens? Did you just cut the bidding off at 6:45, or was there some other extension of time? And there was. Our system allows for 5 minutes of extra time. So if you got into a situation where a bid was placed at 6:44, the clock would be extended for 5 minutes to 6:49. And so that would go on until somebody basically said, no, we're done. Nobody else is interested in bidding. So that was kind of our process. It came across as being fairly easy to understand. We set up a call center, and we had people readily available from their homes to answer questions about the bidding. And honestly, we had a few people call in, but it was really a question about the property. There was nobody calling in with questions about how to place a bid. So evidently, it was easy to understand and place bids for most people. So those were the positives. The negatives, we did have a couple of buyers that said, I'm not really comfortable with this, but they were able to go to their banker, or they had a son or daughter that helped them with placing those bids. And so they were able to find a way to navigate that. So here are the results. And you can see there at the bottom of the slide, in the first quarter, so that would have been January through March, we had 18 auctions. In April alone, we had 10. In the first quarter, we sold 78% of those properties during the live bidding. In April, we sold 80%, 8 out of 10, during the live bidding. Then the next line is percent sold via the auction system, meaning that, well, it didn't sell during the live bidding, but it sold to the high bidder that was identified by the auction within a few hours of the conclusion of the auction. And in the first quarter, that was 94% of the farms got sold. In April, we sold 8 out of 10. We had the first 2 sales. It was interesting. It was the first 2. They, in my opinion, and in our area representative's opinion, achieved fair market value. But in both those instances, we had sellers who wanted a premium over fair market, and therefore those properties did not sell. The remaining 8 throughout the rest of the month did. Now, you might say, okay, stock market at that point had crashed. It was down, what, 35% at one point. What was the value of farmland doing? Commodity prices had dropped quite a bit, so had farmland moved? That would be a fair question. And you can see here, one of the ways we basically kind of measure what a sale price is relative to another farm is this weighted average productivity index calculation, which is the WAPI score in our vernacular. So basically, we take the sale price, so say $8,000 an acre, and divide it by the productivity index, weighted average of the productivity index of cropland, which in Indiana might range from 100 up to 100 and almost 80 bushels per acre of corn. Better soil types are at the higher end of that range, and the poor soil types are at the lower end. And you basically take the soil types that are on that property and average them out, and you come up with this WAPI score, and you divide the sale price by that average productivity index, and you get so many dollars per corn bushel of value. First quarter of 2020, it was $51.25, and in April, it was $50.75. So when you look at that, it really, that's not a significant difference. And so you'd say, well, yeah, the market was basically steady. Sold above release price was almost identical as well. So our sellers do sell most of the time with a reserve, meaning that if it doesn't achieve so many dollars, I'm not going to sell it. And if it goes above that, then I will. And you can see that, 10.6% over release price was our average in the first quarter, as well as in April of 2020. So when we look back at our auctions, the only ones that have occurred since COVID broke out, and they were all in April, we would look at it and say, yep, the change to online bidding was not significant. Basically, everybody adapted to it, and the farm sold reasonably well. I had one of our area representatives in today, and he had a seller, a guy that was looking at buying some land, asking him, what's the market been doing? And since mid-April, there have been very, very few sales. And so as a result, it is really hard to know in June, late June of 2020, where the market is today, because we just don't have any data points at this point in time. Here's just a screenshot of our online bidding platform. I'm not going to go into any detail on this. Again, it's fairly simple to operate, and this gives you a little sense of, you see the property, you can click on parcel 1 or parcel 2 or parcel 3 or combinations, and it'll tell you how much you need to bid to get back in. So it really is pretty intuitive, and you're able to navigate it pretty easily. We do also offer online equipment auctions. So that is something that has probably made a quicker transition than just the farmland has. And there are quite a few equipment auctions that are offered via online bidding. And we did convert a couple of ours for that. Here's an example of one. This was pre-COVID, but it was set up as an online-only auction. And you can see where the bidding opened on February 28th. It closed on March 2nd. And we've had tremendous success doing equipment via online-only methods. So the question you have, I would think, is, where's farmland going? And as I just said, values have been stable. And the question is, for how long? So let's talk about the market today. There aren't very many farms on the marketplace. I look at the farm papers, so I'm talking about Farm World, Indiana Agri-News, Farmers Exchange. I look at them every week. And I can tell you there are very few farms being advertised for sale right now. One of the reasons is there's really no motivation to sell a hard asset like farmland for anyone. Clearly, liquid assets are in a various state of volatility. The stock market was way down. Now it's really recovered quite nicely. But there's question marks, I think, in a lot of people's mind where asset values are going to go. And so they probably just feel more comfortable, especially in the middle of a growing season, to say, you know what, I'm not going to sell my farm. I'm hanging on to it. And there's no tax law change that would cause you to need to sell a farm, or a farm bill change or something like that. So when I talk about outside drivers, that's what I'm referring to. And you'll note on this that it's from 2013 to 2020, we really haven't had any outside drivers. If you go into 2012, prior to President Obama being reelected, we had a lot of sales between August and December that year, all driven off the fact that the general public sentiment was President Obama was going to get reelected, and we're going to see a lot of farms come on the marketplace because capital gains taxes are going to increase. Well, capital gains taxes never did really increase. They basically stayed where they had been. But the fear that they would increase put a lot of farms and people wanted to sell and close in 2012 so they could capture that lower capital gains tax rate. That would be an outside driver. We haven't had anything like that. So the number of sales remain well below normal, and especially larger parcels. So cropland historically kind of always appreciates, except for a couple of time periods in history, which would be 1981 to 1987, and from basically 2013-14 into 2016. And we saw a decline of 15 to 20% from the all-time high in that 2014-15 time period. And then we've been basically stable since then. Recreational, timberland, rural residential values were all higher coming into COVID. That was due to the general economy being fairly strong, unemployment being very low. Clearly, all of that has changed. And I would estimate that probably those types of property that exist in the rural landscape are a little cheaper today than what they were in February. Here's the Federal Reserve Bank of Chicago, the 7th district, which is the one we're in. And this is April to April. And you can see they surveyed their ag bankers and, what has farmland done? And the ag bankers said, well, Indiana farmland went up 4%. Iowa went up 2%. The whole district went up 1%. So while Indiana showed some significant change, the overall district was up 1%. That's probably pretty fair, and we saw some strength at the end of 19, and I think that's reflected in that Indiana number. But generally speaking, a flat to steady to maybe upward market at the end. Here's the Purdue survey, and this survey I just completed 2 weeks ago. So this data will come out here in another month. So what you see here is a year old. But you can see this gives you kind of the overall general trend. You had the peak in 1981, and then we lost value to 1987. And then you can see the appreciation over the years until we got to the golden era in agriculture from basically, from ethanol in China, Chinese demand from 07 through 2013. And then that 15 to 20% drop I talked about, and then this steady period that we've been in. So a little different way to look at land values. Now, I mentioned that WAPI score earlier, and I just wanted to show our trend of sales in 2019. And we talked about the Federal Reserve Bank showing Indiana going up 4%. We saw an increase, maybe a little more significant than 4% even, in our sales in 2019, where we started the year somewhere around $45 a corn bushel, and we ended the year at $54, $53, $54 on average. A lot of noise in that. That shows just the volatility in the farmland market from different property types. But you can see 2019 was a nice slight upward trend. Here's 2020. And so we talked about that earlier. We were hanging right above $50 through 2020. And you can see this goes all the way through our April sales. And so a very slight downtrend from the first of the year. But really pretty consistent right above $50 a WAPI point, which again is higher than the beginning of 2019 still. And then when we don't want to talk about that sideways channel, peak was in early 14. We lost 15 to 20% in 14 and 15, and then we basically have been sideways for 4 years. And that's what you see depicted on this slide. And again, these are all of our transactions. So there's no speculation in this. This is nobody's opinion. These are real live transactions and what they sold for that day of the sale or the private transaction was complete. So who are the dominant purchasers? Yeah, it kind of tends to be a pretty fair mix, 50-50 a lot of years. You had some years where the farmer was the more majority buyer. 14 and 15 that was the case because investors kind of pulled back when commodity prices fell. And likewise, 2019, farmers were back in the marketplace. I think market facilitation payments combined with good yields really fueled the little strength that the farmer buyer had. I've not run the numbers in 2020 yet, but I would imagine it's still pretty heavily farmer dominant. Number of real estate sales compared to previous years. I asked our staff back in March this question, and you can see that through the beginning of COVID, our group said, yep, kind of the same number, and then 26% said more, 32% said less, which at the end of the day kind of averages out to a steady, and that has been below normal, below the normal historical averages. Dominant purchasers in the land market. This is an opinion question. I asked our guys, I said, of all the transactions in your marketplace, not just the ones you do, but all of them, who is the majority buyer? And you can see that 80% of the time, the majority buyer has been the farmer. And that's not a surprise. That's kind of, again, as I said earlier, that's kind of been historic. Farmers are willing to take a little lower percent return on investment than what the investor buyer will. And so they will tend to dominate the marketplace. I'm going to get my slide to move. There we go. So one of the tools that you can use to know where the market might move is this Purdue Ag Barometer. And I don't know if Stephanie's talked about this with you in the past. This is a study that Purdue does, the Center for Commercial Agriculture, combined with the CME group. And they basically reach out to 400 producers across the United States, not Indiana, across the US, each month. And they ask them a series of questions. One of the questions is, how do you feel about the ag economy today? And that's what you see averaged here. This is the average of how do you feel about it today and how do you feel about the future. And this is the highline number most people will see published. And if you go back to when it started in 15 and early 16, it kind of traded right around 100. Well, it's a 0 to 200 point scale. So if you're right at 100, you would say, I feel average about the ag economy. Then you see the big jump timed with the election of President Trump. And so there was a Trump bump, and so to speak, at that time period. And then it kind of hung around 130 all the way until last May, which most of you would probably know why it dropped in May. But when we couldn't get anything planted and commodity prices remained fairly low until you got into early June, there was a lot of negative sentiment at that time. And you see it reflected in this barometer from early May. And then it jumped back up when we got things planted and prices came up and market facilitation payments were announced. And so you got a lot more positive attitude. And we peaked, believe it or not, the peak of the all-time high sentiment of this was in February. And you think about tail of the tape, you know, February, great sentiment, looking forward to a good year, and then COVID hit. And you can see we dropped all the way back to 96, which was an all-time low. Well, no, it wasn't an all-time low, but it was down at a pretty low level. We popped back up here in May to 103. I think that's good news that you saw that bounce back. Not a surprise in my mind, because you did see planting go on pretty well. And we have had a little recovery, at least more so in soybeans than in corn, but some recovery in commodity prices. And the CARES Act support was announced. So I think all those things mixed together caused a little bounce. But certainly we're at the lower end of the range of this barometer today. And still struggling. Okay, I want to move on to talk about farm debt. I'll make sure I haven't missed any slides here with my technological issues. I apologize for that. Shouldn't let me run a Zoom meeting. Okay, farm debt. So this is always a concern, you know, what is happening with debt. And you can see here, and basically inflation adjusted, we are on real estate debt higher than what we were back in 1980-81. If it had inflation built into it, that would be off the charts. But when you adjust it for inflation, we are still higher on real estate, but on non-real estate, we aren't. And so overall debt is probably pretty similar to the all-time high back in 1980-81, which you would say, ooh, that's concerning, Howard, because we know what happened in the 1980s. Well, here's the difference. In the 1980s, you saw interest rates that were 15%. A lot of variable interest rate loans. So these double-digit interest rates created an interest expense, which is the orange line on this slide, or the brown. And you can see we had debt very high, close to where we are now, but the interest expense was double what it is today. So interest rates have a huge impact on farmland values and farm incomes due to this lower interest cost. So while debt is a concern, as long as we remain at these lower interest rate levels, it's going to be muted to some degree. Here's another way to look at debt, and this is debt to equity and debt to asset ratios. And you can see how we compare back to the middle 1980s, where we got upwards of 30% on debt to equity ratios, and today we're at 15.7. So half of that, that's a real positive. So that means that while debt is high, comparable back to 1980, the fact is farmland is more than double what it was back in 1980. And so as a result, that debt to equity ratio is half. And a third way to look at debt, and this is the debt to income ratio. Now this one, when you look at this slide, you really want to look at that 5. And when the debt divided by income gets above 5, that is caution. That's a caution zone. Why? Because you saw us go above that back in 1977, 78, and then you saw what happened in the 1980s, where it got upwards of 13% or 13. We got back above 5 4 years ago, and then it has dwindled downward. So while debt has gone up a little bit, incomes have come up through the last 4 years and have gone up faster than what debt has, and so it's been improving. I'm betting that when the 2020 number comes out, it jumps back up because of the lower farm incomes we may see this year. Working capital is the concern. So this is the fourth part of the debt piece that I wanted to talk about today, and this one's the one that's really concerning. As you think about the impact of COVID and lower commodity prices and lower farm incomes, where does the money come from, the cash come from to support a farming operation? And you can see we had a lot of working capital in 2012, and then that number has really dwindled over the years due to lower farm incomes. Bankruptcies, you do hear about this out in the marketplace, or you see it headlines and in various newspapers, and certainly they are up, but I want to put it in perspective. So start at the top of the slide, 2018, this is across the United States. 498 bankruptcy filings, Chapter 12 filings across the US, 10 per state on average. March of 19 to March of 20, you can see the filings were 627. So it was a 23% increase over the previous year. That's concerning, right? 2008, which is another benchmark year that I've heard people refer to, and of course that was pretty good economics in farmland. There were only 250, very low number. But to put things in perspective, because I've talked about the 1980s a lot this evening, in 1987, the Chapter 12 filings across the United States were almost 6,000. So while we're at 627, we're still a little over 10% of what they were way back in 1987. You see some comments here about FSA direct loans. But my point is, they are going up, that's a concern, but they aren't anywhere close to what they were in 1987, which means you're probably not going to see a bunch of farms forced onto the marketplace. And then here's bankruptcies by state. And so you'd say, well, that 627 is a big number. Well, 78 of those were in Wisconsin. The dairy industry has really been hammered through this downturn in milk prices the last couple of years. And that's reflected in that, as New York and Minnesota. And so you look at this and you say, oh gosh, Indiana had 12 total across the state. So really a pretty low number, historically speaking. So where do farmland values go from here? And where are land values going? I would argue it depends on three things. The primary, heaviest weight goes to farm incomes. And where farm incomes go will have a lot of say in what land values do. Higher farm incomes, higher rents, higher land values. It's kind of the equation. Interest rates. Interest rates are a factor, like I just talked about. It factors into the expense that you pay for your operating line or for your mortgage. It also factors into alternative investments. So what I mean by that is, if you go into your local bank and the bank is offering a 1 or 2% on your CD, and you can get 3% return on your farm, you might be more apt to invest in the farm. And so when financial instruments in the fixed income sector are returning as low as they are right now, that is a positive for farmland as well. And then finally, supply. And supply of farms for sale obviously is purely a supply demand. And when supply is low, that does buoy up land values. Incomes were really good, 07 to 13, generated a lot of cash. They haven't been as hot in the last 6 years, much lower, and you saw that cash drain reflected in the working capital chart. So that's the farm income picture and why we've seen this drop in land values and then the steadiness that we've experienced. Contrary to that is a bullish factor, which is the interest rates, and they are still very historically low. And the supply is also bullish in the sense that there's only 3/4 the normal 2% of farms selling. So the last two factors are bullish. The first factor, farm income, is not. So we'll talk about farm income first. And you can see here, this slide just depicts the crashing farmland income where we were peaked back in 13. They're on the far right-hand side of the chart, and then 5 dots in a row that are all dropping into this year. And so we've seen real net farm income decline. Here's the impact of USDA payments. This is a little different way to think about farm incomes. You can see in the early 80s, they were, oh my land, all the way up to almost 70% of the net farm income was your direct farm payments. We're not anywhere close to that number, but we're certainly much higher than we've been, back, and you have to go all the way back into the early 2000s to see a similar percentage share. So those are important. And when I made the comment earlier that market facilitation payments factor into the sentiment in the Ag Barometer, this is evidence of why that would be. Here's the Indiana Farmland Cap Rate. I said I would mention this. This is the percent cash return. So you take your $200 an acre rent divided by land value, and that's your cap rate. It's a gross, not a net in this chart. And you can see that it's kind of hovered around 3% for the last 7-8 years. That's kind of a bottom number. We do run some budgets these days that'll get into the high 2s, but you can still probably find opportunities in the 3.25 range if you're willing to look and go about anywhere for it. Farmland leases, that obviously factors into what are farm incomes. So I asked my staff back again in March, results of the 2020 cash rent negotiations. So at that point, they're done. Everything for 2020 was done. And I asked everybody, you can see 11 of the managers said our rents were steady with a year ago, 2019 to 2020. 2.5, so I had one person, I didn't have a half a person, but I had one person say, well, it was half higher and half lower. I don't know how you factor that in, but the higher, 2.5 people said higher, $20 to $100 an acre, and 1.5 people said lower. So pretty much it was a steady marketplace from 2019 to 2020 in terms of rents. I asked, did you lower any cash rents? And you can see 3 of our people did, anywhere from $10 to $50 an acre on 4 farms, and one was a $35 an acre reduction. But they took away the fixed rent, took that down $35 an acre, and added a flex bonus in place. So we talked about flexes, and here's a little insight into how ours work. I've been a proponent of these since 1997. We've been using them for 23 years now. And basically, I find this as a way to set a floor for the tenant to know what his guaranteed cash rent's going to be, but it's usually somewhere 75 to 100% of what fixed rent would be, but somewhere around that 80 to 90% range. So the tenant takes some risk off the table on the front end, meaning they're paying a less guaranteed cash rent, but in return for that less risk, they give up some percentage of the net income. And how that's calculated tends to be most of the time off base gross revenue. And you can see here that on corn, that base gross revenue number could be anywhere from $600 to $750 an acre. And what that means is that if the farm produces more than $750 an acre in gross revenue, the landowner gets a share of that, somewhere usually 25% to 1/3. And so let's assume some easy math numbers, because that's what I can handle. Let's say a farm in Grant County made 200 bushel corn, and the average selling price for the year in Grant County, not on the board, but in Grant County, was $3. That's $600 an acre. There, in this case, if your base gross revenue trigger was $700 an acre, there would be no bonus paid. You would pay the guaranteed rent, and you would be done. However, if the cash price averaged $4 a bushel, times that 200, that's an $800 an acre gross. 800 minus 700 base gross revenue is $100 an acre of theoretical profit. And if you're splitting that 25-75, the landowner is going to pick up an extra $25 an acre in bonus rent. So that's the way it works. It does the same for soybeans, just at lower dollar amounts. And you can see here, I asked it, did we change any base rents? And really, on one farm, we did. So I find these flex leases to be helpful in a couple of ways. One, it mitigates some risk for the tenant on the front end and gives upside to the landowner if it's a good year, but only if it's a good year in terms of price and yield. And it also tends to not be as negotiable year over year. So year over year, you might change rents up or down $5, $10 an acre, but a lot of times with a flex lease, it just stays the same. And you can see that reflected in this data here. And then here's the Purdue survey on cash rents, and you'll notice this looks very much like the land value chart. And that's because, as I said earlier, farm incomes, rents tend to drive values. And so you would expect the land value chart to look very similar to the cash rent chart. Here is the USDA survey. So this is the entire United States farmland cash rents. And you can see the reason for the land value decline back 15 to 16, when rents really dropped across the State of the Union, or the whole US. And then they've been slowly on an incline. And again, this isn't necessarily relevant to Indiana, but it does give you a sense of what's happened across the country. And yes, the average cash rent in the United States is $140 an acre. So here's my forecast. Farm real estate, June 18th, 2020. So I want to be real clear, because it's not clear to me where we're going. But here's some things to look at and how you might think about where farm real estate's going to go when some stuff starts to come to the market. And we do have some auctions starting again in July and August now. So we'll start to get some indications of where the market's moving at that point in time. One overriding factor that I think you need to keep in the back of your mind is this long-term world demand fundamentals remain bullish for ag. And why I mention that is I talk to a lot of large investment groups that would be pension plans that want to invest in farmland. And one of the key reasons they want to invest in farmland is because of this factor, that long-term global food demand with water constraints and some other issues, they really believe U.S. agriculture is well suited to provide them a good return over the long term. Interest rates are still very favorable. In that 7th District newsletter, you can see the average 15-year fixed money rate was 4.5%. That is the lowest in recorded history in the Chicago Federal Reserve study. Not all time, but since they've been doing this study, that's the lowest they've ever recorded. Pretty cheap money available out there. Supply of farms for sale remains very low for now. Now, what happens if we get toward fall and the outlook is lower corn prices for a year or two? Do you see more farms come on the marketplace then? And that would be my one concern, is that we could see that supply of farms increase come fall due to some unforeseen circumstances. And really it's going to come down to how much cash is in the countryside. And if that working capital really gets pretty low and somebody wants to farm next year, they may have to take some equity out in the sale of a piece of land. So keep in perspective, farmland values, while they're not at the peak, They're still in the 80th percentile of all-time high values, and they're higher than any year prior to 2011, not that long ago. So you really could sell your farmland for a pretty good value today. So markets other than cropland, timber, I put a question mark down there. Clearly, throughout this COVID-19 shutdown, home builders were able to continue. And what you read out of FC Tucker in Indianapolis and other markets, that the residential market hasn't performed all that poorly. But certainly as we get longer in the year and more of the effects of the unemployment are felt, you could see a retraction in the home building space, which is going to impact timber. Recreational, that is disposable income. That's a property I want to buy to go hunt on or ride four-wheelers, and that probably is going to be weaker today because there'll be less disposable income available. Rural residential kind of tracks with what I just said a minute ago, with that residential market being fairly steady. The one concern I would have is if you own a farm that I would deem as a hassle farm, below average, which means that 80 acres in 5 fields, for example. Tough to farm with today's farm equipment. It's got a creek running through it and a lot of point rows, and it's a hassle to farm. Those probably will trend down more in value than what the really high quality land is. You take some really nice land anywhere around Marion, and high quality, good farm neighborhood, it's probably going to sell at a pretty steady value the rest of this year. But if you have that average to below average farmland, and I'm not picking on any region, but you start to think east of Marion, some of that more rolling land, especially along the river, that certainly might be a little weaker today when we're going into fall. So where do we go from here? If I want to make a bullish argument, and I'm starting with the bullish argument, I'm not saying this is where my head is. Land value bulls are going to point to some of these factors and say, hey, I think the market's going to remain pretty steady. You got a low amount of debt versus assets in agriculture. That's true. You have low interest rates. That's true. And you have a low supply of farms for sale. Those are all true today. And that's what's providing that market, that foundation that's steady right now. Biofuels, now, they were doing all right. Then we shut everything down. That has obviously gone away. Now it's improving. So demand is really low currently. That is factored into that corn price. Does that return as to the levels it was before? That's a real question mark in my mind. But at least the RFS is still in place. And if the economy spins back up, biofuels should remain a positive factor. World population growth, that's that long-term fundamental. Trade deals will help. And I was on a presentation earlier today. The Secretary Purdue was speaking, and he talked about the various trade deals that have been negotiated. We got something done with Japan. He believes still that the phase 1 deal with China will get delivered on. Might be a little longer than originally planned, but it will get done in terms of the purchases they're going to make. We're working on a deal with Great Britain. Now they're talking about a deal with Kenya. So you're starting to see some trade deals, individual trade deals get done. That's better than what we went for the first 3 years of President Trump's tenure. But more of those are going to certainly be needed to help. You do have potential for inflation, and I've not mentioned that yet, but some of your large financial institutions, pension plans and the like farmland from an inflationary standpoint. And historically speaking, when we've had inflationary times, farmland performs very well and goes up in value. And so some people are looking at farmland to invest in because of that. And then water resources and competition. And you have to get out of the Midwest sometimes to get a respect for this. But when you look at the current legislation in the state of California that has cut the available water coming from below the ground on a lot of farms out there, that is materially changing the value of that real estate, in half. And so as a result, we sit in an area where we get 40 inches of rain a year, and God gives us what we need. And so as a result, I would argue that long term is a real positive for the Midwest, and especially the Eastern Corn Belt. All right, now I'm going to switch over to the bearish side. And this one's a pretty easy argument, near term anyway. the pandemic, COVID-19 effects on demand and prices. That's pretty well known today. And you can read any number of prognosticators that are predicting lower corn prices longer term for the next 12 to 18 months, because we're looking at a 3 billion bushel carryout, and that does not, argue for higher than $3 corn, well below cost of production. Soybeans is a better story, but certainly corn the demand for that has really been hurt through this pandemic. And what's the effect of that long term? That's a big question mark. US and global production is enough. Yeah, you know what? We've got enough out there. We have surpluses in most commodities, and that is hurting commodity prices today. So worldwide economy tanks, equaling lower demand. Certainly we're in the midst of that right now. Trade agreements or not. So I had them as a positive, which they could be, but certainly if China doesn't deliver on the phase 1 deal, or we don't get other trade agreements done, that's going to be a negative on demand. And then you've got the biofuels RFS mandate. If for some reason that would change politically, that would be a negative. And then interest rates eventually increase due to inflationary concerns. Certainly there are those that believe inflation is a possibility. And while that's a positive for farmland, usually on the value side, it could be a very negative on the interest rate side, because those would have to increase in inflationary times. So where do we go from here? I think you're looking at lower farm incomes probably in 2020, barring some kind of weather event. And so that would argue for steady to lower farmland values as we go into fall. If I was a seller thinking about selling my farmland, I would do it sooner rather than later, just because sooner I think is maybe a little more known than say November, December. Right now, one of the risks, the other asset classes returns like CDs and liquid treasuries, what I'm reading is interest rates are going to remain low for a while. So that's probably not a big concern. Stock market, there's so much volatility in that. I don't think that's hugely competitive with farmland. So that's not a real worry. The second part of this slide though is, and what happens if farmers have to fund working capital and they have to sell some land or put more debt on land to stay in operation for 2021. And if they choose to sell, then you could see an increase in supply, and that would be negative on land values. Because if you got a lot of farms coming onto the market in September, November, and in the face of 2-something corn, that probably is not a real bullish scenario. So I want to leave you with this, and then we'll have the last 10 minutes or so for questions. President, or I should say Secretary Purdue mentioned this today in a little different way. But if you look at these metrics right here, in 1920, a U.S. farmer fed 19 people. One farmer fed 19. His family and a couple others. In 1970, a farmer fed 26. So in 50 years, we had a 37% increase in productivity. And then in the last 43 years through 2013, it was almost a 500% increase. Secretary Purdue said today that over the last 90 years, we have seen a 400% increase in productivity in agriculture here in the United States. That outshines almost anywhere else. When you think about from a foreign investment standpoint, or even a domestic investor, and they look at the safety of US law and patent protection and the financial system, and granted, you may not feel that those are as safe, but certainly they are safer than most of the rest of the world. And so investing here in US farmland, where we have the best technology, the best farmers, and some of the best climate, becomes a pretty compelling argument. So that's why I invest in farmland and hold it as an asset long term. So Stephanie, with that, I am open to questions. I've got the chat open. I don't see any there. But if you want to unmute people and have them ask questions, they certainly can do that too.
Yeah, if anyone has questions, feel free to, you should be able to unmute yourself and go ahead and ask, or if you want to type in the chat box, that's fine too. So I guess, does anyone have questions right now?
Stephanie, I think you mentioned earlier, but maybe those that came on later didn't hear, you are recording these.
Yes, these are being recorded. And so I will get these first two out tomorrow, and then obviously next week's I'll get those out to you guys by next Friday.
So if you are interested and want to share this with other people in your family or farm operation, certainly you can do that. I don't have any of this that is what I would call proprietary in nature. So if you wish to do that, you can share that broadly.
Absolutely. And yes, feel free to reach out to either of us if you have questions, and I can direct you guys to Howard if you reach out to me. And I guess if there are no questions, we can go ahead and wrap up. Thank you everyone for joining us, and thank you Howard for presenting tonight. It was very, very good information and very insightful, especially with all the pandemic craziness going on. So I will ask you all, I am going to send out another survey. If you guys would give us a little feedback on this session, that would be awesome. Again, it's only 4 or 5 questions, so not much of your time, and I highly appreciate it. And we will reconvene on Tuesday evening, and we are going to hear from Ryan Smith at Central Indiana Ethanol on the ethanol markets and what's going on there. So I hope everyone has a great evening, and thank you again.
Thank you, Stephanie.